Welcome to Loup TV. I'm one of your co-hosts, Gene Munster, along with Andrew Murphy. This is a forum where we can expand a little bit on the questions that we get asked the most about. And today it's related to a recent note that we published about Apple reaching $200 per share. So before we dive into it, I want to give some context to Andrew, who Andrew is. Many of you may know him from other productions here at Loup Ventures. He's one of the managing partners. We've worked together since 2005 and covered Apple in a tandem for many years. And so Andrew brings a lot of background to the Apple story and a lot of context that will be helpful here today. When we talk about that prediction about a $200 share price, it doesn't quite capture the message, which really is, we're talking about a $3.5 trillion company. Wasn't that long ago where 1 trillion sounded like a big number. 3.5 trillion for some may seem like a distant reach and getting caught up in the moment. Not today. Shares have pulled back more recently. We don't pay particular close attention on a week-to-week basis on how these trade. We're more focused on the long term here, but want to bring in Andrew. And Andrew, love just your context when we started talking about this being a $3.5 trillion company. You, as a good partner in all this, had some understandable questions.
Yeah, it's been a crazy ride. We also, though, want to be intellectually honest about every time we suggest that Apple's got another leg to the story. And they seemingly always find bigger and better ways to leverage the business that they've built to increase the value to consumers and the profitability of the company at the same time. But again, each leg to the story should come with some serious rationale around why we think the next leg is feasible. And that's what I wanted to ask you about today. So okay. What's the basic summary that you would have around the services business and the multiple expansion that the company's seen over the last few years?
So the last few years has been getting to what I would call it fair market value. And Apple has long traded at a deep discount to its other tech giants. And the reason is that they have a hardware business. And that hardware business historically has been unpredictable for investors, which has generated a lower multiple. Think of what happened with Nokia and BlackBerry. And so for a long time, I think over the past year, 2 years, what's really happened with the multiple is just a better awareness that Apple as a whole is more of a services business. Apple as a service includes not only their services part of their business, but their hardware business having more predictability like a service business. And so when you put all that together, it's understandable that the multiple has closed. To me, it's just some sobriety around how investors are thinking about their multiple and finally giving the company the credit that it has long deserved. But that gets us to where we are today. Yeah,
so in your view, is the services business priced in to the multiple and the growth we'll see over the next few years?
I don't think it is, because I think there's a whole another leg to the services story around the hardware piece. We're gonna hear more about their software or their services around Apple Music, News, iCloud, some of the bundling around that in October. But I think that the services piece around the hardware, I think that eventually they're gonna come out with this 360 bundle, which will basically allow you to pay Apple one monthly fee and you get your hardware upgraded every certain period of time. That to me is the nirvana around services. That's not fully reflected in the multiple yet. We're certainly closer though.
So we've gone from a 15x multiple just a couple of years ago to closer to a 30x multiple today. What do you think the multiple will be in a year? And if you think it'll continue to expand, why do you think they can do that?
So it's the investors' decision here. The people who are the biggest investors in Apple ultimately decide that. But I think that there is a strong case that Apple should trade at a premium to its group. And I generally think of its group as the broader FANG, very different. Each of them has a different type of business. And so I think that a reasonable multiple is in the mid-30s. And I think it's understandable that that view has gotten some pushback because they're going to grow revenue over the next few years, probably in the low teens type of range, maybe 15%. But why does that justify a 35 multiple? And I think the answer is that the stability around the business is going to become ever more apparent. Uh, One, because of the products that they have and the services around that, which we can talk about. But second is this acceleration to this to a digital future, digital first future that the pandemic has been driving. We're even more tied, more dependent upon our Apple products and services today than we were before.
Let's talk about both of those things. First, the recurring nature of Apple's business. You've compared it to the likes of Coca-Cola or Clorox, but now Apple's multiple is at those levels, right, in the high 20s. Why now do you think that it can go higher than those companies' multiples?
I think we can use those two, Coke and Clorox, as benchmarks. And if you look at Coke's business, we have to normalize for the pandemic and also do some normalization for Clorox's business. Coke's has been hurt, their business has been hurt, Clorox has been benefited. I think when you put them both together, those businesses are growing kind of in the low to mid-single digits. And ultimately, they're trading kind of at a mid-20s to high 20s multiple. And in the case of Apple, as I talked about, I think that this can be around a 15% growth rate for the next 5 years. And if you believe that and put it in the context of Coke and Clorox, I think that that is a strong justification for a higher multiple. I do believe that Apple now has reached a point, especially more recently, about being just a fabric of our lives. And specifically, is just like Coca-Cola and Clorox are, I think Apple now stands alongside those companies.
And then you mentioned the pandemic and the acceleration that we're seeing in certain businesses. What do you think has changed for Apple?
Well, the obvious is in the near term, just around the need for their devices, whether it's work or learn from home. We've seen this surge in Mac and iPad demand. There's nothing insightful around that. The piece that is more forward-looking is that I think that some of those growth rates can continue over the next couple quarters, but still be in this high teens rate for Mac and iPad businesses that haven't done much. And essentially what's changed is now there's been a handing of the baton from companies and school districts to parents and people working from home to do their own tech needs. And that is in the wheelhouse of what Apple does, being able to take care of their own tech. I recently had an experience where a problem with my MacBook Air, and went online to get it fixed. I had no idea if the stores close to me were open or closed, but the experience, essentially, I logged into my account, it knew my machine, it knew the serial number, it knew the warranty I had in it. I dropped it off at the store, and 4 days later, returns to my home, mailed back to my home. Just an incredible experience. But when you think about how we are going to become more dependent upon doing these things for ourselves, Apple is in a wheelhouse. It does beg the question about how much is this the new normal? Is this the reality of what we're going to be looking like? And my view on that is, if you think of today, approximately 80% of knowledge workers are working from home. That number probably is going to gravitate back down to 20 or 30% in the years to come. I think it's going to be at a much higher than it was 5% before the pandemic. And at that level, I think a 20+% of people working and learning from home longer term, I think that is a major tailwind for Apple.
Okay, but since the pandemic set in and the stock bottomed out, it's been on an absolute tear, and people seem to be getting to understand and bake in their thinking this change for Apple. Do you think it's priced in already?
No, and the reason is that people are looking at the recent June quarter, the September quarter, December, possibly what 5G looks like for the company. They're not really thinking about this kind of sustainable long-term. And the reason why I believe that they're not thinking about that is if you start layering that into the model, you get to earnings numbers for 2022 close to 20% higher than the street. Simply, the models aren't reflecting it, assuming that the sell side has some reflection of what investors are thinking. And so I believe that we're not there, number one, on the numbers, and number two, this concept about just how tied we are to this company. I think I've long followed this and have understood that there are kind of leaps in their business. You can go back and look at them. I think what is happening in our dependence upon Apple is not factored into investor thinking. And we're just going to, quarter after quarter here, be impressed at how much we're going to be dependent upon the company.
Well, there you have it. Apple to 200. No further questions.
Thank you, Andrew. And thanks everybody for joining Loop TV. Bye for now.